This video is going to be for all of the peeps out there that still don't quite understand what happened with the whole GameStop short squeeze situation. Maybe you've watched some other videos, you've talked to some friends, and it's still not quite clicking for you. Hopefully it clicks for you after this video. We're going to keep it simple, high level, and we're going to start now. What you have to understand about the stock market is that it's based on speculation. Yes, a company's fundamentals like how much cash it's producing, its revenue, its profit margins, those things are important. But fundamentally, the stock market operates on speculation. And there's two positions that you can take. You could either think that the price of a stock is going to go up over time, in which case you are long that stock. And there's the opposite side of that. If you think that the price of a stock is going to go down, you are what's called being short that stock. And there's ways to make money using both speculations. If you think that the price of a stock is going to go up, if you're going to be long a stock, the way that you make money is by acquiring that stock. You purchase it and then you wait until it's at a higher price point than what you acquired it for. And that's how you make money. If you want to make money shorting a stock, there's a couple of different things that happen. You obviously don't want to own something if you think the value of it is going to go down. So let's go through a brief explanation of how you make money shorting a stock. Alrighty, if you think that the price of a stock is going to go down, what you do is essentially go to your brokerage and you ask them to borrow the stock. And the stock lets you borrow it in exchange for an IOU. You have to basically give that stock back to the brokerage, not the monetary value, the stock itself. And so if you borrow 10 shares, you're going to have to give those 10 shares back to your brokerage down the road. Alrighty, so let's say that the current market trading price for GameStop is $10 per share. Let's say that you only borrowed one share. And then you use your brokerage to find a buyer and you sell that share. So now you have $10 in your pocket off of this stock that you borrowed from your brokerage account. And some other buyer in the market has the share of GameStop that you borrowed. So some time passes by, let's say that it's 3 weeks later, and let's say that your speculation that the price was going to go down was correct and it paid off. So now instead of the price being $10 for GameStop, the current market trading price for GameStop is $3. In this scenario, you have the $10 cash and you have that IOU, and there is a seller willing to let go of their GameStop share for $3, which is the current market trading price. So what do? You take your $10 that you made from selling it 3 weeks ago, you subtract $3 because that's what the market trading price is today, and you pocket this you pocket the $7 difference, and now you have that one share of GameStop that you're able to give back to the brokerage, and that's how you make money shorting a stock. But what happens if the price of the stock doesn't go down? What happens if it goes up instead? What happens if your speculation was incorrect? That's called a short squeeze, and it made a lot of investors, hedge fund managers principally, lose a lot of money with the GameStop short squeeze. How does this happen? Let's just say that instead of the price going down to $3, it started going up. And what drove it to go up? Basic supply and demand principles. There was more demand for the stock, so the price went up, and now it's trading at $33. And so you're freaking out. Why? Because you have the $10 that you got from selling the trade when you borrowed it from your brokerage, and in order to close out your position, you have to buy the stock back from the market. And now the stock price is $33. So 33 minus 10, you're going to have to front $23 out of your own money in order to acquire that stock back and be able to give it back to your brokerage that let you borrow it. And if you multiply this across hundreds of thousands or millions of shares that you have as your short position, that's a pretty big loss, and a lot of hedge fund managers were hit pretty heavily because of this. This chart, I think, does a good example of illustrating the concept. You started off with $10 that you made when you sold the share to the market after borrowing it from your brokerage. At $3, you're making that profit, but if it goes past $10, you're going to start to lose money pretty significantly and pretty quickly. And that's why it's called a short squeeze, because instead of the price going down, you're getting squeezed because the price is going up and you're losing a lot of money. And what drove the price of GameStop to go up? What you have to understand is that there is a popular website called Reddit, and Reddit is basically an online community discussion forum. There's forums for literally any topic that you can think of. One of those forums is called Wall Street Bets, and they discuss pretty much the stock market. And there was a user on Wall Street Bets by the name of Keith Gill. Well, his username was Deep Effing Value. I don't want to cuss because of the YouTube algorithm. And his name is Keith Gill. And he basically did a ton of analysis and a ton of investigation with publicly available information to figure out that there was a pretty big short position in GameStop. And the short position was probably held by hedge fund managers because they're the ones that have the capital to take those kinds of positions. Hedge fund managers is basically another fancy word for an investor. They have capital coming in from various different sources, wealthy individuals, pension funds, and the whole idea is that they're going to make trades that make money and make their clients money, and they get to pocket some of that difference. And so they had this short position. This user figured it out. He posted about it on Wall Street Bets on this forum website. And a lot of Redditors that saw that information got excited, and they got the idea that if enough of them started to buy the stock, they could cause the price to go up just a little bit. And that's exactly what happened. And a lot of the hedge fund managers, when the stock price was going up just a little bit, started to freak out and closed out their positions. And you have to remember, when you close out your position, you have to actually buy the stock back. And that increases demand and it increases the stock price to go up. And so essentially a function was kickstarted where as hedge fund managers continued to close their positions and as more people through social media started learning about the situation and realized that it was a way to hurt hedge fund managers and Wall Street basically, I don't think it's any surprise that there's not the greatest public sentiment towards Wall Street. They got in on the stock and were driving the price even higher. I think at one point it reached 300, maybe even higher than that. And then things got messy. Eventually, the price was continuing to go up, but Robinhood and a couple of other brokerages did this too. It wasn't just Robinhood, but they're getting the most heat because I think it was reported that half of their users owned at least one share of GameStop. And Robinhood pretty much prevented people from being able to buy more of that share. And a lot of people were upset because the public investors, retail investors, were unable to buy, but institutional investors were able to continue to buy no problem. And so it presented basically a series of unfair advantages to institutional investors that retail investors didn't have. And Robinhood's gotten a lot of heat. There's been some congressional hearings about this, and I'll make some videos about that soon. But more or less, the reasoning that they gave was that they have certain capital requirements that they have to fulfill, and they didn't have enough cash to be able to fulfill the volatility and the activity that was happening. And because of that, they needed to stop and pause the bleeding in order to basically be able to get that capital. It's kind of shady though, to be completely honest, because there were a lot of reports of people that had large positions in GameStop through Robinhood. Basically, Robinhood automatically closed their positions without their permission. And so the public's really unhappy about this. Robinhood's under a lot of scrutiny, and I don't want to get into a ton of more detail on what happened beyond that because I want to keep the focus really high level and basic and simple to explain to those that don't understand what happened. So hopefully this video was helpful. Hopefully you understand what the GameStop short squeeze situation was and what caused it. And the story is still unfolding. We don't know what the end of this is going to be. The stock price has dropped significantly and the story is unfolding. So if you have any questions or comments, leave them in the section below and I'll be happy to address them. And I'll see you guys in the next one.